Right now, while most people are watching war headlines and refreshing their portfolio, something is unfolding in the global financial system that almost nobody is connecting to their crypto holdings. Oil just did something it has never done before in recorded history. The supply shock currently hitting the global market, driven by the Hormuz closure, is removing nearly 20 million barrels of oil per day from global supply. To put that in context, the Russian-Ukraine war of 2022 removed 2 million barrels per day and sent oil from $70 to $130 a barrel. The Iranian Revolution of 1978, one of the most destabilizing oil events of the 20th century, removed 5.5 million barrels per day. The current shock is 10 times the size of the 2022 event. It is larger than the top 5 historical oil supply disruptions combined. And the markets opened this week with the S&P down 2%, the Dow down over 1,000 points, NASDAQ down 2.5%. Futures opened in the worst way in a very long time. Here is what the mainstream financial press is missing entirely. They are covering this as a war story, an oil price story, a geopolitical uncertainty story. All of those framings are real, but none of them are the actual story. The actual story, the one that connects oil, the yen carry trade, global liquidity, and XRP into a single coherent picture, is the story of a financial system being stress tested beyond its design limits at the exact moment that its replacement is being assembled. And if you understand that picture, this moment looks less like a crisis and more like a catalyst. Welcome back. I'm the calm analyst. No panic, no noise, just the structure underneath the chaos. Let's go deep. Let's start with the mechanism that most people in this space describe but rarely fully explain, because understanding it is the key to understanding why this oil shock is not just a macro event. It is a financial system event. The yen carry trade is one of the most important structural forces in global markets, and one of the least understood by retail investors. Here is how it works. Japan has maintained near zero interest rates for decades. That means sophisticated investors, hedge funds, institutional traders, sovereign wealth funds, can borrow Japanese yen at essentially zero cost, convert that yen into higher yielding assets anywhere in the world, earn the spread between 0% borrowing cost and whatever the destination asset yields, and then repay the yen loan later. This sounds simple. And when global markets are calm, it is enormously profitable. Hundreds of billions of dollars worth of carry trades are running at any given time, funded by cheap yen, deployed into equities, bonds, real estate, commodities, and yes, crypto. But here's the trap that is built into this structure. When something disrupts global stability, when geopolitical tension spikes, when volatility surges, when the risk calculus changes suddenly, carry trade investors unwind. They sell whatever they bought. They buy back yen to repay the loans. And the unwinding happens fast, because everyone in the carry trade is watching the same signals, and they all move toward the exit at the same time. What does an oil shock of historic proportions do to that dynamic? It does exactly what we are beginning to see right now. It spikes uncertainty to levels that, according to global uncertainty indices, are now higher than COVID, the global financial crisis, and the dot-com bubble combined. It pushes inflation expectations upward, which changes interest rate expectations globally, which changes the math on the yen carry trade, which begins the unwinding process. And when the carry trade unwinds at scale, the liquidity that has been flowing freely through global markets constricts. Assets that were funded by cheap yen liquidity, including risk assets, including crypto, face selling pressure not because anything changed about their fundamentals, but because the funding vehicle that was carrying them is being recalled. That is the reverse carry trade. And the signals that it is beginning to materialize are appearing right now simultaneously. Oil at historic highs, Forex volatility surging, global uncertainty at record levels, stock futures gapping down at open. Now ask yourself the brutal question. What happens to a financial system running on 1970s infrastructure when global liquidity constricts this fast and this hard? Let's do the math on what this oil shock actually means for the real economy, because the numbers are not abstract. US oil prices are up over $55 per barrel in 3 months, a 100% increase. Current economic models indicate that if these levels are sustained, US GDP growth will decline by approximately 0.5%. equivalent to roughly $160 billion less in economic output. At the same time, unemployment levels are already moving in the wrong direction. An inflation report is coming, and oil does not just affect the price at the pump. Oil affects the cost of everything that needs to be transported, shipped, or delivered, which is essentially every physical product in the economy. Every price needs to be readjusted. Every cost model needs to be recalculated. Every supply chain that assumed stable energy costs is now running numbers that do not work. And that repricing happens everywhere simultaneously: in food, in manufacturing, in logistics, in construction, because oil is embedded in the cost structure of the entire physical economy. The US has already spent over $9 billion on the Iran conflict in less than 10 days. $1 billion per day, $41 million per hour. The Pentagon is reportedly preparing for a conflict that could last until September. If that timeline holds, oil does not stabilize anytime soon. Inflation does not cool anytime soon. GDP growth does not recover anytime soon. And here is where this connects directly to the financial infrastructure story that most crypto analysts are not making clearly enough. When liquidity constricts, when the carry trade unwinds, when GDP growth slows, when inflation spikes, when Forex volatility surges, the demand for fast, efficient, reliable settlement infrastructure does not decrease. It explodes. Because every institution that is trying to manage risk in a volatile environment needs to move capital faster, more reliably, and with less friction than the current system allows. The Nostro Vostro system that locks $27 trillion in idle pre-funded buffers was designed for calm, predictable markets. It works passively when nothing is wrong. But when a 20 million barrel per day oil shock is reverberating through every currency pair, every cross-border payment corridor, every settlement system simultaneously, the inefficiency of that infrastructure does not just cost money, it becomes a systemic risk. The demand for instant settlement rails does not emerge someday. It emerges exactly in moments like this one. Now let me connect this macro picture to the institutional moves that have been quietly assembling in the background, because this is where the picture becomes remarkable. Treasury Secretary Scott Bessent stated it directly. The Trump administration is going big on digital assets. Stablecoins alone could create $2 trillion in demand for US treasuries, up from approximately $300 billion today. He said the prior administration starved and almost made extinct these companies and pushed the industry offshore. The current administration's stated objective is to apply the highest US regulatory standards to digital assets and weaponize stablecoins as a financial instrument for American economic dominance. Weaponize. That is the word he used. Not regulate, not permit, weaponize. Think about what that framing means in the context of an oil shock that is simultaneously destabilizing petrodollar flows, threatening the dominance of dollar-denominated settlement in global energy markets, and creating conditions where adversarial nations are accelerating their own digital currency infrastructure to escape dollar dependency. Iran already operates a crypto shadow economy. Russia has stablecoin infrastructure larger than Tether. These are not future threats. They are operational systems running right now, designed specifically to move value outside the reach of the traditional dollar-based financial architecture. The US response is not to ignore that threat. The response is to build faster, more capable, more globally accessible digital dollar infrastructure, and to do it before the window closes. $2 trillion in treasury-backed stablecoins. Dollar-denominated digital rails operating 24/7, 365 days a year, in any corridor, at any scale. A financial weapon that keeps the dollar at the center of global commerce, even as the physical petrodollar system comes under pressure. And at the infrastructure layer beneath those stablecoins, the settlement rails that move RLUSD and other dollar-backed assets between institutions, across borders, in seconds, sits the XRP ledger. Now let's stack the institutional validation, because this is not just a macro thesis. It is documented, confirmed, and actively being built. Franklin Templeton spoke directly about a universal liquidity layer at the Ondo Finance Summit in early 2026. The quote was precise. As demand rises for a universal liquidity layer, broad interoperability on-chain could bring new on- and off-ramp pathways, new yield-bearing opportunities, and a massive shift to move assets onto blockchain. They describe the prime brokerage infrastructure being built around these rails, enabling assets to move out of fragmented accounts into unified on-chain wallets where new demand is emerging. Universal liquidity layer. That phrase is not incidental. In a world where oil shocks are constricting liquidity, where carry trade unwinding is pulling capital out of risk assets, where forex volatility is spiking, the demand for a universal liquidity layer that operates outside of these pressures and provides instant settlement, regardless of macro conditions, is not theoretical. It is the exact solution the moment is calling for. The DTCC patent, describing digital liquidity tokens and cross-ledger settlement architecture, names XRP and Stellar explicitly as the bridge networks in the routing diagram. The DTCC processes $2.5 quadrillion annually. It has already added Hidden Road, acquired by Ripple, to its back-end infrastructure. The patent is pending final approval. Franklin Templeton is connected to the Stellar network. Ripple is connected to the DTCC through Hidden Road. Both networks appear in the same institutional infrastructure patent, and both are being positioned as the settlement rails for a financial system that is being redesigned from the ground up to operate 24/7, 365 days a year, without the settlement delays and pre-funding requirements that make the current system vulnerable to exactly the kind of liquidity shock we are experiencing right now. The Bank of Canada ran its tokenized bond pilot at the same moment the Royal Bank of Canada, one of 7 governance banks in Ripple's network, surfaced as a confirmed Ripple partner. The TCS Bank's infrastructure, processing $40 trillion in securities annually, has Ripple in its architecture. The MasterCard RLUSD settlement pilot is live. The OCC, the Fed, and the FDIC have jointly cleared banks to hold tokenized assets. Every one of these institutional moves was made before this oil shock, before this forex volatility spike, before this historic uncertainty index, before this carry trade unwind signal. They were made by institutions that were not reacting to crisis. They were positioning ahead of it. That is what smart money does. It does not respond to the headline. It positions for the structural shift the headline is accelerating. Here is what I want you to understand about the specific nature of this moment, because it is unlike any previous moment in the digital asset space. Every previous major geopolitical or financial crisis has eventually led to a system upgrade. The 1973 oil shock broke the Bretton Woods system and gave birth to the floating exchange rate era. The 2008 financial crisis gave birth to quantitative easing and the era of central bank balance sheet expansion. COVID accelerated digital payments and contactless commerce by a decade in 2 years. Each crisis accelerated a transition that was already beginning. Each one created conditions where the old system's limitations became undeniable and the pressure to adopt the new infrastructure became irresistible. We are now experiencing, simultaneously, an oil shock 10 times larger than 2022, global uncertainty higher than any measured point in modern history, the early signals of a yen carry trade reversal, and the most constructive regulatory environment for digital assets ever assembled in the United States. Those 4 things are happening at the same time. The old system, built on correspondent banking, nostro pre-funding, T+1 settlement, and paper-based trade finance, was already showing its age before this week. The oil shock is not creating that vulnerability. It is revealing it. And the institutions that have spent the last several years quietly building the replacement infrastructure are not surprised by this moment. They anticipated it. They built for it. Treasury Secretary Bessent said he would take a close look at regulatory impediments to blockchain, stablecoins, and new payment systems, and consider reforms to unleash the awesome power of American capital markets. He said Americans deserve a financial services industry that works for all Americans. Under current oil shock conditions, with inflation returning, with GDP growth under pressure, with the petrodollar system being stress tested, the urgency behind that statement is not political. It is existential. The fuse on digital asset infrastructure adoption was already lit. The oil shock just shortened it dramatically. Let me speak to the people who are feeling the weight of this moment, watching their portfolio while the stock market opens down 2% and oil spikes to levels nobody predicted. I understand the fear. When macro uncertainty hits these levels, the instinct is to reduce risk, to move to safety, to wait. And in the short term, that instinct is not irrational. Carry trade unwinding creates selling pressure on risk assets, including crypto. That is real, and it may continue for a period. But here's the distinction that separates the informed from the crowd. Short-term selling pressure driven by carry trade mechanics and macro fear is not the same thing as long-term structural demand changing. The carry trade money that is exiting crypto right now is not exiting because XRP's utility changed. It is exiting because the funding vehicle that brought it in is being recalled. That is noise. The signal is the infrastructure being built, the patents being filed, the governance partnerships being confirmed, the regulatory framework being assembled. When the carry trade unwinds and the dust settles, the infrastructure will still be there. The DTCC integration will still be there. The Royal Bank of Canada governance partnership will still be there. The Clarity Act will still be advancing. And the oil shock, by accelerating the case for instant settlement rails, for stable digital currency infrastructure, for on-chain liquidity that operates outside of traditional market hours and geopolitical friction, will have made the institutional case for this transition stronger, not weaker. Being early in a structural shift feels exactly like being wrong during the volatility phase. Every major asset class transition in history has had a volatility phase where the old system breaks loudly and the new system is not yet visible to the crowd. We are in that phase right now. The question is not whether the new financial plumbing gets built. Franklin Templeton, the DTCC, Ripple, MasterCard, the US Treasury, and the Bank of Canada have already answered that question. The question is, who is positioned in the infrastructure layer of that plumbing when the volume starts flowing through it? Here is everything I want you to carry forward from today. An oil supply shock 10 times larger than 2022 is hitting global markets. Global uncertainty is at record highs, above COVID, above the financial crisis, above the dot-com bubble. Stock futures opened down 2%. The yen carry trade reversal is showing its first signals. Liquidity is beginning to constrict. And simultaneously, the US Treasury Secretary is weaponizing stablecoins as a financial instrument. $2 trillion in Treasury demand is being targeted. The DTCC is launching its tokenization service this year with XRP in its patent architecture. Franklin Templeton is describing a universal liquidity layer that connects directly to the infrastructure Ripple is building. The Clarity Act is in final negotiation. Hidden Road is integrated into DTCC back-end systems. The Bank of Canada ran a tokenized bond pilot. The Royal Bank of Canada is a confirmed Ripple governance partner. Every major geopolitical crisis in history has accelerated a financial system transition that was already beginning. The oil shock does not change what is being built. It accelerates the timeline for why it is needed. Oil going parabolic leads to global liquidity constriction. Liquidity constriction leads to demand for faster settlement rails. Faster settlement rails mean digital assets become the global bridges. That is not a narrative. That is the pattern of every major system transition in modern financial history, playing out right now in real time. Comment "bridge" below if you made it all the way through this analysis. I want to see who is reading the macro picture and connecting it to the structure, not just reacting to the red candles. Stay patient. Stay rational. The old system is being stress tested. The new system is already being installed. The transition is not a question of if. It never was. We don't wait for the future. We plan for it.